What's up, everybody? It's your mortgage expert, Brian McCauley here. So are you a 1099 contract employee and you're looking to buy a house or even refinance your existing home mortgage, and you're running into troubles qualifying because your 1099 show a lot of money, but your tax returns show all the write-offs and some lenders may not want to qualify you? Stick around. In this video, I'm going to tell you how to get around that by using our 1099 only home loan program. Let's get into it. So listen, as interest rates start to come down, the DFW housing market is heating up. We're seeing a lot of buyers come out of the woodworks. We're also seeing existing homeowners that bought a house a year or two ago looking to refinance to get a cheaper rate and payment. But one of the things that we're running into and that we're seeing are self-employed people, 1099 people. This is always a challenge in the traditional home loan world where people make money, they just don't show it. And so today's video is about some of these portfolio niche programs that I'm going to continue to do videos on. This one specifically is about 1099 employees or 1099 contractors. What happens is normally when somebody's a 1099 employee or a contractor, they get a 1099 at the end of the year, but they usually have some expenses. And so let's say hypothetically their 1099 is $100,000 all in. They may have expenses at the end of the year on their tax returns, mileage on their car, advertising, marketing, you name it, that might be $50,000. And so that 1099 is 100 grand, their expenses are 50 grand, so the tax returns only show 50 grand left over. And that's what a lender using a traditional loan has to use to qualify them. And sometimes that can't give them the buying or the refinancing power that they want to. Now, traditional home loans that require tax returns, W-2s, things like that, are loans that you hear with the name of like Fannie Mae and Freddie Mac, conventional loans, FHA loans, VA loans, and USDA loans. All great loans. I do all those loans too. But what about all the people out there that don't fit in the box? More importantly, what about all the people out there that don't fit in the box, but they have good credit, they make money, they just don't show it the proper way? So this 1099 program is for you. We have a special niche internal portfolio product that is really designed for every type of self-employed borrower, no matter how your business is set up. We've got profit and loss loans, we've got 1099 loans, we've got asset-only loans. And so again, I'm going to do a couple more of those videos and drop those soon. But this one is specifically for the 1099 person. This goes both for a purchase and this goes for a refinance. This goes for a single family home, a rental property, a second home, all of the above. So if you're 1099, listen up. This program has probably helped, I would say, at least 10 to 15% of our clients every year. So if we help about 300 families a year, I would say 30 to 45 people that get denied from your traditional home loan stuff, your tax return, come to us because of our 1099 program. And why the 1099 program is so cool, there's three real reasons I want to talk about why people like it, why it works, and how it puts them in a much better position. So number one, the 1099 program, we will give you 90% of whatever your 1099 itself says. So again, using the example from before, if we made $100,000 on our 1099, we wrote off $50,000 in expenses, our tax returns would only show $50,000. That would be 50% of 1099. That's not going to get the job done. We will take 90% of whatever your 1099 is. So if you've got $100,000, we'll use $90,000, take that and divide that by 12, that's your monthly income. It will help so many people that are 1099 people qualify for a new home, qualify for an additional home, or even people that are in current homes that want to refinance, lower their rate, maybe take cash out, but you can use this 1099 program for that as well. And you can also use this 1099 program to buy second homes, vacation homes, rental properties, so it doesn't restrict you to just a purchase of your primary home. It's purchases, refinances, primary, secondary investment. Game changer. Part two on this that I want people to realize is a lot of times when people are 1099 and they don't maximize all their tax deductions and they take less deductions than they could because they want to show a really good tax return to the mortgage company that shows that their bottom line is enough to qualify. The challenge on that becomes if they don't maximize all the tax deductions, they may end up owing more money to the IRS than they should. So here's a simple example. Let's say somebody made $100,000 as 1099, they had $50,000 in expenses, but instead of taking all $50,000 in expenses, they only took $10,000 in expenses because again, you don't have to take the expenses. It's your option. Most people want to because obviously they want to pay less in taxes, which is smart, but from a mortgage standpoint, they may not take it. And so if they did it the other way, where they took $10,000 in deductions until their bottom line income was 90 grand, they would have a $90,000 threshold and $90,000 tax bracket that they have to turn around and pay Uncle Sam income taxes on $90K. So let's say the difference of them paying $50K, $90K, it's $40,000 difference in income. I'm not a tax expert, but it puts them probably in about a 25% tax bracket. So if there is a $40,000 delta between what they could deduct and what they did not deduct, you're probably looking at about 10 grand in extra money in taxes to the IRS. So in 1 year, if you don't maximize your deductions, you could end up spending an extra 10 grand roughly in that scenario paying to the IRS, where if you took the deductions, only had 50 grand to show, and you use our 1099 program, you would save yourself 10 grand. Now, what happens is these home loan programs, the interest rates are a little bit higher, maybe 1% or so higher than your traditional mortgage. But if you look at it, it actually saves you money. And here's what I mean. For an example, if you went the traditional route, you might be able to get 6.5 on the rate. If you do the 1099 portfolio route, you're probably gonna get 7.5 on the rate. Yeah, is the mortgage payment gonna be $200 higher? Sure. But I want you to think, if you're able to maximize all those deductions and keep that 10 grand in your pocket, but you've got to pay an extra $200 a month, which one's better? I would probably say the 1099 actually saves you money in the short term and long term. So if you can keep that $10,000 in your pocket and maximizing all your deductions, but you can do the 1099 program and use 90% of that to qualify, even though the mortgage payment is $200 higher a month, it saves you, the consumer, a lot of money. Even if you pay $200 higher a month for a year, that's $2,400 higher in payments. You did it for 2 years, that's $400 higher in payments. So you really have to get through about 4 or 5 years of payments to break even what it would cost you if you paid Uncle Sam. Most people won't keep the mortgage that long. I'd rather you pay a higher mortgage and pay in at least a mortgage balance, pay your principal down and get tax deductions, than have an IRS check go out to the window to nothing. But that's just my opinion. Second really cool thing about this program is it allows for 6% seller concession. So it allows for the seller to pay for up to 6% of closing costs with only having to put 10% down. So this is big on all home loans. So why it matters a lot of this program is if you don't love the 7.5 rate and you find a house that you can get a deal on, instead of taking $10,000 or $15,000 off of the price, just ask for a $10,000 or $15,000 closing cost credit and then buy that interest rate down from 7.5 to 6.5 at the seller's expense. So now you've got the rate that you want and the payment that you want with a 1099 program that you're able to maximize all your tax deductions, save yourself $10,000 from the IRS, still get a more competitive rate and qualify for a home loan, therefore that you couldn't have if you did it the alternative route. So keep these things in mind, right? Part 3, which probably doesn't matter a ton right now, but it will in the future, I promise you, refinances. So a lot of times 1099 people, they might have had a good year, they might have had a bad year, they might have had a year where they made some money, but they bought a house 2 or 3 years ago. So what happened? They didn't take as many deductions because they wanted to have a stronger tax return, and they closed on that house back in 2024, paid a little extra money to Uncle Sam, everyone was happy, and they said, okay, great, I don't have to do that again. Well, now things come back around, interest rates are dropping. They want to save money, 1%, 2, 3, take cash out of the property. But now we're back to square one, which is, well, they had a good looking tax return 2 years ago, right? But anytime you're getting a refinance or getting a new mortgage, whether it's a new house and a new purchase, or you're obviously resetting it with a refinance, you still have to show the ability to qualify for that new mortgage. So if that 1099 person comes back and wants to buy a new house, or even just say, hey, let me refinance my existing one. I did it 2 years ago. Rates were at 7.99. I could probably do a refi now and get it down to 6.5 and save myself some money. Great, Brian, let's chat. Well, the issue is if their tax return from last year looks more like the ones in the past before they had a better tax return when they bought, they probably won't qualify. And those 1099 people are probably not going to want to go do another tax return, not take all the tax deductions again and have to pay them twice. So this sets up an opportunity for people that are 1099 to say, hey, you've already done the tax return things once. If you had, you can use this to refinance any type of house, primary house, secondary house. You can do a rate term refinance. You can do a cash out. There are a lot of alternative options. So I just have been seeing more and more of these alternative structures of self-employed contractors, self-employed employees, 1099 contract employees that just have money, make money, good credit, but your old school, traditional, conventional FHA, VA style loan, it just won't allow for it, and it puts them in a position to where they can't buy, or if they were able to buy and they're in a different position now, they can't qualify for the refi. We're trying to save people as much money as we can. So these niche non-QM portfolio products that I have are game changers for a lot of people, whether you're looking to buy, whether you're looking to refi. I want people out there that either know somebody that's in this industry that's, 1099 or a contract employee, or maybe it applies to you. And I think last but not least, I want everyone to be mindful that this isn't the only niche self-employed 1099 contract style program that we have. We have a bunch more. The other cool thing about this is you can use multiple 1099s. So let's say you were a 1099 for X, but you did 2 side jobs. Oh, I painted houses and I got a 1099 for 20 grand. I did that for a few months. Oh, I ran a baseball card shop and I got a 1099 as well. You can use all the 1099s. So it doesn't have to be just a 1099 in your mainstream job. So these programs are flexible. They're helping a lot of people get in much better positions, buy, sell, refinance homes where they otherwise couldn't. So I think these will continue to become more popular. People are looking for alternatives. When they look at it at face value, yes, the interest rates are slightly higher, but when they think back of, oh, well, I actually should a whole lot more of my taxes. And I always say, like, look, if you think it's a worse deal, let's go back in time and say, hey, if you had to file a tax return and not take the tax deductions in order to qualify for a traditional loan, but you get a more competitive rate, what does that look like? And when they go back in time and say, man, I probably end up having to pay $10,000, $15,000, $20,000 into the IRS in 1 year to show a tax return that's got bottom line income so I can get a traditional loan, that costs a lot of money. Versus I want to maximize my deductions. I'd like to keep that 15, 20 grand in my pocket. And then, yeah, I might take a interest rate that's 1% or so higher. That's maybe $200, $300 higher a month a week. When you compare a $10,000, $15,000 tax bill in 1 year to maybe a $200 higher mortgage payment over 2 or 3 years, it's a no-brainer. And that's with the assumption that you don't even get any seller credits. If you get seller credits in the contract and you can buy the rate down from whatever it is, as low as you want to go, now you got the best of both, right? Maximize all the tax deductions, keep everything in your pocket, traditional rate, buy it down over here with the seller concessions. Now you got the most competitive rate with the seller buy down rate, the niche program, everybody wins. So I think this is becoming more popular in the future. I think more people are going to entertain it. I think more people are going to spread the word. And I think it's going to help a lot of people become homeowners and refinance their existing mortgage where they otherwise couldn't. So listen, if you found this 1099 home loan program valuable, do me a favor, like, comment, subscribe, or share it with somebody that you know that could benefit from this. We all know somebody out there who's self-employed 1099 and they've got money, they make money, they just don't show it and they're going, I'm tired of renting. I want to buy, but I don't want to pay all these taxes. Or I bought, but it was 3 years ago, and now my taxes don't look so great. My 1099 does, and I want to refinance, but I can't do it. Yes, you can. Give us a call, shoot us a text, send us an email. We are always here for you. Until next time, stay tuned.